You're watching us here on Chartbusters. I'm Mangalam Malu. With me, as always, Nigel D'Souza. We'll talk about the markets in just a bit. But for now, Bata, that was the company that reported a softish third quarter performance, mildly below street expectations as well. But the company has made some interesting announcements. I spoke with Gunjan Shah, who's the managing director and CEO of the company, to discuss their plans going forward and the third quarter performance in detail. First up, tried to ask them about the demand environment, which he said that was weak at the lower end of the price point, as a result of which the stock at the low point of trade.
We do see some kind of a divergence. I think on the positive side, the premium section of the business, which is in the price points of 1,000, 2,000 and even higher, are doing really well and actually leading the growth for us. That is also signified by brands like Hush Puppies, Comfort, Sneakers, even our new washable footwear, which is Floats, that is doing exceedingly well. And combined together, all of them are growing in the range of almost 20-30% higher than last year and even above, obviously, pre-COVID levels. However, there is a certain amount of sluggishness that you see in the price points which are below 1,000 and especially below 500. And that has seen some amount of sluggishness right from about September onwards. I think it's a cumulative effect of the kind of inflation that consumers have seen overall and the price increases that we have taken to manage this inflation from a footwear perspective. So hopefully that should even out, but that is how we see it right now.
You know, I'm looking at some further details in your numbers. Your overall volumes are still 5 to 6% below pre-pandemic levels. Is that largely on account of the weakness that you're seeing in the lower price points? Where does it go from now? What are you doing to ignite that, demand once again?
Yeah. So, see, there was at the start of this year, which is January, we did have also a GST impact besides the raw material inflation. Now, combined together to manage the business, we had to take in some amount of price increases. That does have an impact on volumes for a certain period of time. We are hopeful it will wane away as cycle base takes over. The other thing is that for the second half of this year, cumulatively between, let's say, July to December, we did see positive growth even higher than pre-COVID volumes. But for this quarter, yes, it was 5%, largely by this mass category sluggishness that I talked about.
What are your thoughts on growth going forward then, and even margins? Because now the raw material inflation is somewhat on the wane, and you are seeing some sort of recovery even in the lower end of the spectrum. That's what all the other FMCG companies are saying as well. Could you, concur with that or, counter that? And what happens to your margins? Do we see further improvement back to the pre-COVID levels of 26, 27%? Any inkling on by when you get there?
So we don't give forward-looking outlooks, Mangalam, but however, I think commenting on some of the levers, raw materials, while they are a little different from some of the FMCGs, but we do see some flattening out. It's early trends yet. We would like to see it for a longer period of time, but I'm sure we should see those benefits. We have now, for the last almost 6 months, now staved off for any further price increases. So that cycle base should basically start impacting volumes positively going forward. So we'll wait and watch on that front. As I said, the demand on the premium side is pretty strong, and we are wanting to make sure that's in line with our premiumization strategy, and that continues. So that should keep fueling growth for us going forward.
What's the timeline that you have for the coming together of all these initiatives that you're taking? You know, we're talking about you expanding your stores via franchise, you shutting non-profitable stores at the same time, looking at increasing your ad spends, repositioning your brand, so to say. All of that brokerages believe are steps in the right direction. But what they wonder is by when do they actually, bear fruits? Do you have any timelines on that?
No, we see internally, we see signs of that showing us, tangible shifts in various metrics that we measure for. So premiumization is working. We see ASPs going up. Even in our, so for example, in our Hush Puppies, our ASPs are 4,000 plus, and that's growing strong. Our sneakers continues to drive growth for us, and therefore is showing a significant delta versus our overall growths. We also see a significant amount of newness in our portfolio across the range, right? And whether it's in terms of fashion quotient or even in terms of stylishness, that has gone up by a significant index across, festive wedding collections that we launched, the pop colors and sneakers, Floats range that is extremely attractive. even in our school business, we are bringing up a significantly shift in the kind of newness and fashion quotient from a sporty range. So all of that is showing up in indices. We are seeing consumer feedbacks, the average age of consumers coming down for us. So all of those are showing. I think that clubbed with the entire expansion strategy that we have been on for some time. Last quarter, we saw the largest ever addition of franchise stores. It's a significantly capital efficient model. And all of this hopefully augurs well in the medium term in terms of deliverable back to the business.
Can you quantify what is augur well mean? I mean, are we looking at mid-teen sort of growth for the next financial year with improvement in margins? That's one. Not asking you for specific guidance, but is that a reasonable assumption? That's point number one. And you've reached over 2,000 stores now. I'm told that you're looking at the apparel category as well. What are your thoughts there?
Yeah. So as I said, we don't give forward outlooks, but the objective is towards making sure that we get back to attractive and strong CAGRs with sustainable and profitable growth. And some of these, both premiumization, getting the portfolio newness, as well as making sure the expansion and the efficiency should kick in. We are also backing this with significant investments. Last year saw the highest ever marketing investments that we have done. That will continue. We are also significantly involved investing in digitization, and that should basically flow through in terms of efficiencies as we go forward. Sorry, I missed your last part of the question.
Apparel. You are looking to get into apparel.
Right. So, see, apparel, we had started off on a project on apparel. It's a very attractive category. It's very adjacent to the kind of consumers who walk into our 2,000 odd points of sale. Right. And that has an attractive both in terms of growth as well as in terms of profit pool. We had started a certain pilot pre-COVID. We had kept it on halt. We are now aggressively restarting it. Watch this space. Hopefully, we'll have an update a few months down the line.
All right, we will await that. If you could tell us, what's the kind of investment that you're looking to earmark on that and all, along with the kind of revenues that you are expecting, any broad outlook right now before we get to fine-tuning those numbers would be good. And finally, the last time we spoke, you had an FY25 target, given the average revenue that your every store does, etc., of close to around 5,000 crores in overall sales. Is that still on the cards?
That was a number that you had back calculated, Mangalam, but I wouldn't say it's out of reach.
All right. And apparel, how much are you looking to invest in it?
It's too early. As I said, watch this space, but we are looking at second half or most probably end of the second quarter of next financial year to make sure that we make our entry. So we will have a much more detailed update on it down the line.
Right, that really is the big headline. Footwear maker Bata is looking to get into the apparel space as well. Nigel, my sense is he's very tight-lipped about it. He's saying the apparel is an adjacent category. Power is one of those brands where, they make sport shoes, etc. He's saying sneakers are doing well. If he gets into fitness wear, etc., I mean, that could be a biggie for
and parallel to what he's doing as well.
Parallel to what he's doing, they have 2,000 stores. So, I mean, people can't just go to the stores to buy
distribution is there.
Yeah, shoes. So, Power, we will watch that space for sure.
Yeah, absolutely, Mangalam. And good interview. I mean, fairly interesting out there. Maybe in the near term, the core business is a little bit shaky, in terms of demand. But as Mangalam said, they're going to be going into a new business vertical. That's the big headline out there. So we'll keep playing you snippets of this all through the day. But that was Bata stock a little bit under the weather. For the time being, though, let's shift focus to our special segment, where we get you a few ideas for profit from Money Control Pro. Sachin Pal of moneycontrol.com joins us to talk about a stock that he's tracking rather closely. Sachin?
The stock in focus today is Dalmia Bharat. It recently came up with its Q3 numbers and it turned out to be a big beat both in terms of top line as well as on the margins front. Revenues for the quarter came in higher, almost 23% year on year, driven by a combination of higher volumes which spiked to 6.3 million tons, a growth of almost 11% year on year. Reliance also witnessed a similar improvement thanks to the steep price hikes that the company witnessed across the eastern markets. Margins were under pressure on a year-on-year basis, but witnessed massive improvement on a sequential basis thanks to the receding cost pressures. Power and fuel costs have been trending downward in recent months, and the current trend indicates that the company should be able to witness an improvement of almost 100 to 150 rupees per ton in Q4 given the current pricing. The pricing as well has remained quite firm with the start of the busy construction season from Jan to June, and the volumes are again anticipated to grow higher in 24, given that the government has already outlined a capex of almost 10 lakh crores in the last budget. The company has also announced an acquisition of JP Associates in the central region, which diversifies its presence away from the eastern as well as southern markets. Overall, the company is taking a number of initiatives both on the organic front as well as on the inorganic front and remains a structural play on the cement industry. Investors should therefore keep the stock on radar for accumulation on corrections.
All right, we take a short break now. Come back on the other side. We have the management of Sheela Foam discussing their third quarter earnings, but more importantly, the outlook for the near future. Rahul Gautam joins in.
Welcome back. Well, the markets have come off a little bit from the high point of the day. We're down close to around 30 points. Nothing really to worry. The Nifty bank, that's not really participating, so that's a bit of a drag. Though the IT index, as we've been pointing out at the last few days, the Nasdaq does well, the IT index will do well, and that's why the IT index continues to do a relative outperformance. But let's move to our next management, Sheela Foam. They reported a weakest set of numbers in the third quarter. The revenues are down by close to 7.5% on a year-on-year basis, though the gross margins were up 340 basis points. The EBITDA margins as well saw some compression due to higher other expenditure. Well, to understand what's the way ahead as well as what went on in the past quarter, we're joined by Mr. Rahul Gautam, the Managing Director of the company. I'm Mr. Gautam. Good morning, and thanks so much for speaking to us here on CNBC-TV18. Well, whenever you join, sir, we get a bit of an insight into your company as well as in terms of TDI prices, which is very, very important for GNFC. Now, I understand, in the last couple of weeks, the last 10 days or so, there has been some traction on TDI prices. Could you tell us what is the uptick we have seen on TDI prices?
So this has still been, sort of oscillating around like nobody's business. And till December, middle December, they were kind of mellowing down or slowing down a bit. But let's say from January onwards, the increase has almost been about 30 rupees per kilo, which is, and so today it's at 245. And like you said, in the last 10 days, it's gone up by 12 rupees.
All right, Mr. Gautam, just to confirm that then, TDI prices are up by around 30 rupees, is what you're telling us.
From January onwards.
From January. Oh, that'll be very, very important. For you, it'll hurt you, but for JNFC, that'll be a rather important data point because that's more than a 10% increase for JNFC, and their core product is TDI prices. So just keep an eye out on the JNFC stock as well. But Mr. Gautam, well, let's talk about your business. How is demand on ground, and what do you look to end this year with?
So demand on ground is lukewarm, to say, to find the right word for it. Quarter three, which has just finished, which is always the largest or the biggest quarter that we have, was also okay. It was very patchy in the sense that 10, 15 days okay, and then another 5 days slower. So that's what we've been experiencing. I think it is steadying down. January and whatever few days in February that we have, it's better than the previous quarter, and as I said, but again, the raw material prices seem to be playing a spoilsport here.
Right. So what happens to the gross margins? Mr. Gautam, because you had said that the gross margins were sustainable, the expansion of nearly 400 basis points. Now, the raw material inflation has raised its ugly head once again, and demand is still patchy. So just wanted two numbers from you. One, for the entire year, what is the kind of revenue that you're estimating? You did just about 2% in the first 9 months. And margins, can we see further correction from third quarter levels into the fourth quarter?
Yes, we would see corrections on that. And let me just say that as far as raw material, straight away on a quarter four impact may not happen. The inflation would probably take some time because of stocks and because of material in the pipeline. However, if you look at the year that is going to end off, I would say we should be about 6% over the last year, over the previous year.
So the first 9 months you've done 2%. You believe that the fourth quarter will make up for that and you will see 6%?
I think the number is probably closer to 4%. 3 to 4% last year.
All
but
right.
anyway, that's what we see is about 6%.
So you'll end this year with a 6% growth over FY22, right?
That's right.
And what about margins?
right.
You said there'll be some compression. Do you want to give us a number?
I don't believe that there would be too much of a compression. We are trying to compensate for the increase in raw material prices by passing them on to the consumer. And then there is always that bit of a lag effect, which is there, due to the stocks and the inventory and the material pipeline.
Right. If you could give us a sense of all the other geographies, just trying to understand for FY24, what are the targets that you have? You started FY23 with a 15% sort of revenue growth target. Understandably, things weakened, they got patchy, etc. So you'll end up with 6%. That's what you're estimating. FY24, what targets do you have? You do have a lot of new brands that you've seeded, businesses coming in from the railway, etc. If you could break that up into, how much comes in from India, how much comes in from Australia and Europe.
So let me just go to the overseas part first. Australia has been doing, touch wood, very well. And this is because of a lot more stability out there and the Australians spending more money, because they're not traveling around as before. So that should end up almost about 12 to 13% over the previous year. As far as Spain is concerned, whatever hit that it had to take on account of the Ukraine war, it has taken and has now been creeping up as far, but it may end up about 7-8% lower than the previous year because the impact on the entire market, of course, has been much larger, almost about 20-odd% as far as Europe is concerned. So we should see about 6-7% hit there in Spain. India, I have already said that we should be about 6%.
That's FY23 that you're talking about, Mr. Gautam. I'm asking about your
Yes.
targets for the next year, FY24.
So I may not be able to give you exact, because we still have to have our planning portion. In any case, there is also so much of instability that is there that to probably give a. But I would say that if somewhere it is related to the GDP. And if I would look at the past 10-15 years, we've generally been the industry's been tracking about 2 times the GDP, and so has Sheila Foam.
Okay.
Not a little better than that.
Talking about India's GDP, sir, and the sector that's really firing and going in full speed is the railway space. That's an opportunity for you, right? As of now,
Absolutely.
I think it's a small portion of your business. I think you do maybe 8 to 10 crores odd per month of business from the railways. But
That's
where do you
right.
see this number scaling to?
I would say that this number should end up at about 350-400 rupees per 350 to 400 crores per year.
By when?
By 25.
By 25.
FY25.
So from 120 crores at current reckoning, at current run rate, you'll be going up by 3 times in the next 3 years.
Right. So, the product has been well accepted. The product has been exactly what the railways want. However, the switchover takes its time,
Right.
because there is so much where the previous product, etc., is there.
All right, Mr. Gautam, run out of time, but not out of questions. Hopefully, we continue our conversation on another occasion. But for now, the headline that we will take away is that your railway business will triple over the next 2 years. And demand, however, for the remainder of this year still remains patchy. 120 crore business turning into 350 crores. I guess the railway passengers will sleep well.
Absolutely, Mangala. On the other data point, the TDI prices, 30 rupees higher is quite a large quantum. And as we speak, I think JNFC is at the high point of the day. Remember, bulk of their revenues and profitability comes in from TDI prices. Mr. Gautam said it's been very, very volatile. But from the lows of, of January itself, it's moved up by 30 rupees. And that's why I think JNFC as well has moved to the high point of the day. Volatile commodity, but keep an eye out on that. For the time being, slip into a short break. You come back, we'll continue our focus on markets as well as stock-specific action.
Welcome back. The market continues to do market things. The Nifty is up about 100 points, mildly off highs, but really no worries. The dips are being bought back closer to the higher end of today's trading range, 18,120 thereabouts. But what's really taking your breath away is the way the mid-cap index is moving right now. I mean, you do have a bunch of stocks which are spiking. Oil India continues its march forward. It's up 17% this week on good numbers coming in. The other one I'm looking at is Jubilant FoodWorks. Not particularly great numbers for that counter, but you know, after the dip that we've seen, there has been a bit of an uptick on Jubilant FoodWorks, currently at the high point of trade for that counter as well. Emphasis is the third one, which has moved to the high point. But we'll focus only on Jubilant FoodWorks as we wrap up on this edition of Chartbusters. Nigel, are you buying us pizzas? Can we expect them before 12?
I've already ordered it. In the next 20 minutes, it's here.
All right, 20 minutes it is. We wrap up on this edition of Trading Hour, Chartbusters. Trading Hour comes up next.